by your size. This can't be a heavyweight in the portfolio, but I like it. I like this hairiness. I love this puking action. Even if it goes down to $10, it's going to rebound. You can't bet against Steve Roth. And the big thing here is this is like malls. You have Simon Property Group, who weathered when all the B malls went belly up and they were toast. Simon Property held tight. They've got the Lululemons, they've got the Apple stores in every single mall, and they've got wealthy people. It's the exact same thing with Boston Properties and Vornado. These are the creme de la creme of office properties. The problem is they're the most well-known of office properties, so the fact that everyone's nervous about lease renewal and everything else, they're going to get hit. Their vacancy is going to go down. The question is, how much is priced in with the stock down 75%? And the assets still being the premier assets in the greatest cities in the country, namely New York City. And you know, I've got a place on 40th Street on Bryant Park, and I got to say, the city has changed in the last couple of months. I mean, it was depressing the last 2 years to go there. Dirty, you know, people sleeping, all the things you don't want to see. And I'm not saying it's magical or anything like it was during the Giuliani and Bloomberg eras. But I will say there's a market improvement. People are coming back to the city. There is action. There is excitement. There is energy. And it's the greatest city in the world. So Vornado just happens to have the highest quality office properties in the greatest city in the world, which, like every other time and every other cycle, people say will never come back. And I think this time what you're going to find is the people who want to be in the greatest city in the world want to be in the greatest buildings in the greatest city of the world. And if you want to do that, you're going to be in Vornado. And yes, people are going to work remotely 3 days a week, but they still need a desk and a chair when they come in for the 2 days a week or the 3 days a week, or what will ultimately become the 4 days a week, and maybe back to 5 days a week if the labor market gets softer. Everyone will rush in to go to their jobs. But the fact of the matter is, I think the risk reward is interesting. Could it be a donut hole? Yes. So size it appropriately. But I think more likely than not, you're going to see a dividend cut, and then the stock is going to rally. So we think it's interesting. We also think Mortimer Zuckerman over at Boston Properties, you know, his is high. He's got the high tier in Boston. This one hasn't quite fallen as much, but I think it's a similar story. So, you know, if we're going to, I met Steve Roth, like a decade ago. I know who he runs with. I know how he operated through the financial crisis. I know how he thinks. I know how he operates. This guy's not getting taken out on a stretcher. So if I'm going to bet on one of these things, and, you know, risk is commensurate with reward, I'm going to bet on this jockey, just like I'm betting on Gelsinger, and these are hairy situations. But I think when we look 2 or 3 years out, when the dust settles, you got doubles or triples, they meet our IRR standards, we deal with some short-term volatility, we add on weakness, and we go on to the next stage. But if they didn't get wiped out during the great financial crisis, which was much more onerous conditions than right now, I don't see how they're getting wiped out now. But I could be proven wrong, and the key is it'll be sized in a way that if I am, we're not going out on a stretcher, and if I'm right, we're going to make a better than expected value IRR dramatically over the next few years on this, and we're willing to take that risk reward. And if it goes down to 10, that'll be great. We'll top up and bring our basis down a little bit as well. So, by the way, let's just take a look. Maybe I have Vornado here. Yeah, here we go. So let's take a look. The book value is $27 a share. It's trading at 15, which hypothetically means if they liquidated the buildings today, their vacancy rate has gone down from occupancy rates has gone from 90.3 to in line with 90.4. Their other occupancy is 87.3, down from 89.6, and they've got California Street is down to 87.3 from 89.6, and then this other one, 555 California Street's at 94.7% occupancy versus 98.1. And yes, well, their average monthly rent's up 3%. That won't continue, so let's assume rents go down. The stock is down 75%. So, you had a book value when it was trading at $63 a share. You had a book value of $28. Now it's trading at $15 a share. You got a book value of $27. So, I mean, you had funds from operations were obviously higher. At 475, 483. You now have it at 3 to 325. So that's come down 30 some odd percent, call it 40%. The stock's come down 75%. So, I mean, this is what always happens on overshoots, because people extrapolate with recency bias. What happened most recently is going to persist. The revenues, by the way, troughed out in 2020 at 1.3 billion. They're now back up to 1.6 billion, which is down from the peak of 2.1 billion. So yeah, revenues are down 25%. The stock is down 75%. Do you think enough is priced in? Well, no, not if you think revenues are going to go to 800 million, then no, you shouldn't be buying the stock. We happen to think that they'll probably flatline, 1.5 billion, 1.6 billion for the next couple of years, and then they'll hockey stick because their assets are scarce, greatest buildings in the greatest city in the world. If you think that's going to change and New York is going to be replaced by Miami, and there's never going to be a big hurricane in Miami, then God bless. Go live in Miami and good luck. But, we love these things when there's hair and when people think you're a little bit crazy. You're going against the trend. A lot of times events are overblown on the good side, overblown on the bad side. So all you hear right now is the worst place you could be is commercial real estate. Well, thanks for telling me that 75% ago. I'm interested now that the market's already priced it in, or at least 80% of the problem, by the stock trading down 75%, with book value being down, 5%. And that book value will come down and all that nonsense. But yes, you have some walking away from buildings that don't make economic sense, et cetera, et cetera. And we see all this stuff. But again, greatest city in the world, greatest buildings in the world. They'll lose a couple buildings, but their balance sheet's strong. They were actually selling ahead of this. So they won't be out in the market buying. Income and revenues will be a little flattish until they're not. And in the meantime, you collect a 10% dividend until it gets cut in half to 5%, and then the stock starts to rally. So